In today's episode, Paul and I reveal the one true way to become rich using life insurance. A lot of people, a lot of financial entertainers out there claim to know the way, but we're going to reveal the secret to you today. Stay tuned. Hi, I'm Dave.
And I'm Paul.
And we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right. Paul, you're sitting somewhere new. Where are you at today?
So I'm in a room that people used to use for dining, and now it is just a room where there's Tammy's work laptop, there's mine, there's a hutch over there.
So it's the official dining room in the house. Hey, Tammy. There she is saying hi.
Yeah, we are. So now we're forever immortalized
Yeah, we're recording.
on YouTube.
Yeah.
So yeah,
Nobody uses those anymore.
No, we don't. We have a beautiful dining room table that someone built for us at my last duty station. You know, it's real wood and it's a farmhouse table. But yeah, today I think I was having a connectivity problem with my mesh system. So I think I need to add another hub to extend that signal upstairs. So if there's any internet geeks, give me some tips. But I'm getting 700 megabytes per second down here. Upstairs in my office, I'm getting like 40 or 50, which apparently isn't enough.
Yeah, you need more of those radio waves or Bluetooth waves, those EMF signals running through your house, man.
Yeah, I can't get enough of it.
Can't get enough. It's good for you, I hear.
That's right.
Yeah.
So we have a good topic today, though, don't we?
Yeah, it's a popular one. Man, if you do any search online of infinite banking, you're surely going to come across a post or several about how to get rich using life insurance or using infinite banking. So, I mean, you see it all the time. What have you seen?
It's everywhere, and folks, you can go probably on YouTube or just like a Safari search if you're using a Mac or a Google search or whatever, and you'll see these things pop up, and then within that search, you'll see people advocating using whole life insurance or using IUL. Generally, is the two things you're gonna see, and I think what we're gonna get at today is I think it's mostly just clickbait.
Yeah. How to get rich buying cars. Well, let me tell you something. There is one way to get rich with life insurance. It's not buying cars. It's not accumulating enough cash value in your policy, but there is one surefire, guaranteed way to get rich with life insurance. The thing is, somebody very close to you has to die, right? You got to be the beneficiary of a life insurance policy that's in force when that person dies, and you may very well get rich, like our kids will.
Yes. Of course, they'll be old, hopefully, when that happens.
Yes.
And then, of course, within that, rich is a relative. What I remember growing up, and I would see a BMW once in a while, and I remember being like, oh yeah, those people.
Oh, they're rich. Well, you know where I see the most nice cars is driving through townhome complexes.
Interesting.
Yeah. So my neighborhood, it's a new development. You got houses and you got townhomes. You drive through the townhome complexes with the garage doors open. I see like 2 Lexus SUVs in a single garage. Another one is a BMW and a Tesla. And I'm like, I mean, you used to think, oh, anybody who drives those kind of cars must be rich. Well, no, I think the statistics say the exact opposite. Most people who drive those cars are leasing them. One.
That's right.
And
which
two,
is the worst way to buy a vehicle.
Yeah, it's the worst way to operate a
way.
vehicle. Yep.
Yep.
Hands down. Nelson says so. And he's not the only one who says so. But yeah, they're very popular because I don't know what the obsession is. I mean, you're a car guy. I'm I'm not so much. I'm not obsessed with that. I want a nice car, but I don't need a BMW.
Well, I think it's the culture we live in today as well. We are just marketed constantly, and it's gotten worse since the advent of these all like a Facebook type thing or Instagram or TikTok. You're just constantly bombarded with whatever, and then people's idols that people that they follow, or I guess an influencer, which I think is the dumbest thing, but whatever, that's fine.
Right, but they're showing off wads of cash and really flashy cars, and they look like they're maybe 30 years old. So it sends that false message that, hey, if you're not successful by this age, you're doing something wrong and you're never going to be successful.
Right.
Which the truth is, most people don't hit their streak until well into their 40s or even their
Correct.
50s.
Yeah, we discussed that in the last episode that hasn't come out yet, but yeah, you hit your stride like in your 40s and 50s. Your most productive years, in fact,
Yeah.
will likely statistically be in your 50s.
And
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 maybe
ideally,
beyond that.
yeah, and by that time you've got the life experience and the wisdom to be able to handle that kind of money, which most people probably don't know how to handle that kind of money when they're in their 20s. And they're not going to have a whole lot of that remaining, 10, 20 years down the line. But going back to, if you want to get rich, be the beneficiary of a policy. That's the only way you're going to get rich with life insurance.
At
Life
least quickly.
insurance, yeah, quickly. Like you can accumulate a very nice pile of capital in your whole life policies if you've had these things for 20, 30, 40 years and you're paying significant premium relative to your income.
Yeah.
No doubt you will accumulate a lot of capital and have access to all the growth on that tax free, which is great. But rich, yeah, I don't know about that.
No, I don't think so. And a lot of the stuff that's out there, and there's some good content as well, but there's a lot of content like that that's, I think, it's clickbaity and it's deceiving, and it's purely done for marketing purposes to make something seem better than it actually is. Now, do Dave and I love dividend paying whole life insurance product? Obviously, we both own, between the two of us, 20-ish policies, or maybe more than 20 now. We both pay significant premium relative to our personal incomes. But that being said, as in a practical sense, you're not going to get wealthy just buying and owning dividend paying whole life,
Right.
right? But when you implement the process of becoming your own banker, the IBC process, you can enhance, and that's why we're doing it, right? This enhances everything else we're doing in the financial space, and that doesn't matter what financial thing you like to do, right? You could be a real estate person, you could be a stock market person, you could be a private or hard money lending person, you could be someone who runs a rental car business or business owner. Doesn't matter. The process of IBC and controlling that function of banking will enhance your finances over time, without question.
Yeah, no doubt about it.
It's simple math. I mean, no doubt about it.
Yeah. So I was talking to a gentleman just today. He's 50 years old. One of my clients actually introduced him to infinite banking, so he set up time to talk to me about it. And he told me this story, and it probably resonates with a lot of people, where he's been in this industry that kind of goes up and down. So some years he makes a whole lot of money, some years he doesn't make so much money. But he works really hard to build up this portfolio of, say, his 401k or his savings account. And then something happens, either a reduction in income because of a bad market for the business he's in, and he's got to pull money out and spend it. Or, an emergency happens and he's got to liquidate some 401k investments because he needs the money today. Can't wait till he's 59 and a half. And he goes and spends it. But every time this happens, it's a cycle. You build it up and then you spend it down. Every time it happens, he starts back at zero, which is so unfortunate. If you if you first would put your capital into a policy and then borrow against that cash value to go, because there will be emergencies. You will have up years and down years, most likely, in your career, salary wise, income wise. You pull that money out to live on and handle those emergencies, then guess what? It's still compounding in the background. You haven't lost the opportunity to earn interest on those dollars for the rest of your life. Because as soon as you have the ability, you're back on the upswing, you just put that money back in there, replenish your cash value availability, and you didn't have to start again from zero. You get to start where you left off, basically, or where you would have been had you never taken it out in the first place.
Yeah, that's right. And in Becoming Your Own Banker, Nelson talks about a headwinds and tailwinds, right? He was an aviator, an Army aviator, by the way.
Well, we won't hold it against him.
A chief warrant officer 4, I think he's what he retired at. Anyway, but what you just described is the typical American scenario, the typical American problem. Is they're in a constant headwind, right in their face, 30 knots all the time, but they're not. Unfortunately, most are not going to be introduced to IBC. They're not going to recognize the problem. It's not going to dawn on them like there's something wrong here. There has to be a better way, right? And I want to shout out to Carrie real quick. I just had a side note that yes, I do talk slowly. I just realized that.
Yeah, you talk slower than me. So yeah, we have a faithful listener who listens at 2.0 speed. That's pretty crazy.
Yeah, that's pretty fast. But anyway, so they can't get ahead. They have to, not only interrupt the compounding of their retirement account and start back at zero, like you said. They're also paying income tax on that they weren't expecting to pay until after age 59 and a half, and they're paying a 10% penalty on the money that they've taken out.
Right.
Unless he's actually one below. Of those,
yeah.
Right. Which there's very few criteria now, outside of the COVID rules from 2020 and then the 2.0 or whatever. But now it's, the rule of 55. There's some other, but he's not doing that. He's just taking straight up hardship withdrawal if his custodian allows, which it sounds like it does. But anyway, it's just, that is part of the overall problem that Nelson talked about, right? I mean, he was not a proponent of qualified plans in general, but that's a different story. So yeah, that perpetual financial headwind is the problem because our people are not controlling the banking function, right? And they're not getting rich doing it that way, for sure.
No, certainly not. So, yeah, it's the banking function. Taking back control of the banking function in your own life is going to improve whatever you're already doing. It can't not improve whatever you're already doing. So it doesn't have to be, a lot of people still are stuck in this, well, if I'm doing this, I can't do that. Right? It's not either or. It's both and. Like we say, and I described to this gentleman today, he said, well, is this the only thing you do? Is put your money in policies because you have so many of them and you pay a lot of premium. I said, absolutely not. Like you and I always say, this is just the first thing I do with it. If this is the only thing I did with it, I don't think I'd be able to create the scenario that's going to allow me to live a completely passive income life as I get older, and an income that increases every year. It would take a whole lot of premium to be able to do that.
Yeah, a whole lot of premium now and over the next 20 or 30 years. So yeah, I think, passive income time, is certainly a great supplement. And in our episode from this past week with Ryan Fleming, he discussed, sequence of returns risk and how, having paid adequate whole life premium for a long duration, how that can, take someone's safe withdrawal rate on their other asset at 4%, let's say, to maybe a 9% or 10%. And of course, these are numbers that are, that will vary, but at least you'll have that reliable passive cash flow that you can take from your system of policies, because you shouldn't have a one and done. Again, we've talked about it on this podcast. We're always striving for improvement, always striving to make more money, always striving to be more efficient, always striving to pay more premium, right? To make our family banking system as large as possible. And again, just to get back on the original topic, it's a interest recapture. This is get rich slow, right? This is legacy planning. Now, if you don't care about those things, then you're not our people. Our clients, our listeners know that part of this is legacy. It's important. But again, the idea that you're going to get rich financing your cars, you're not. Will you be more efficient doing it this way? Yes.
Yeah, for
Will
sure.
you have more options? Yes, because you're not interrupting compounding. You still have access to all your money. You're not starting at zero like a pay cash buyer or a finance buyer. They're on the perpetual zero line throughout their life. And how many cars are they going to finance doing that? How many college educations are they going to finance? I mean, it just goes on and on and on. By just controlling the banking function using dividend paying whole life, you will end up again with that perpetual financial tailwind over time.
Yeah, which gives you a faster ground speed. So we could explain that, from an aviator perspective, the way a headwind and a tailwind interact with you. Most people probably understand this intuitively. If you're going 100 miles west to east, but you have a 30-knot headwind coming right at you, headwind being it's coming towards your face at 30, then your ground speed is 100 miles an hour minus 30, 70.
That's right.
So you're actually
70.
going a lot slower than you think you are. It's kind of like that rate of return. Hey, I'm getting a 10% rate of return. You're just looking at your indicated airspeed on your airspeed dial in your airplane.
Yeah.
And it's saying you're going this speed. But if you look at the ground speed, you're actually going a lot slower, because now you have to take into account the headwind factors, the taxes, the interest you're paying to outside institutions, not having control of the banking function in your life, interrupting the compounding in your investments. Like, all of that stuff is headwind, and it's slowing down the time it takes you to get from point A to point B. And all we do is shift it around to the tail, make it a tailwind, and it adds to that. Now you're going 130 knots or miles per hour ground speed, even though your indicator only shows 100.
Right. Some people might say, and we've covered this in our objections to IBC, they might say, hey, but I've got a little bit of startup costs in the early years, right? Like, not every dollar I've paid in premium is going to have an equal dollar of cash value that I can access, and that's all true, folks. Right? That is all true. But again, going back to Nelson, thinking long range, right? Not being afraid to capitalize, right? The virtue of being patient, right? And the reward on the back end of that, and it's not that long. Like, it goes by like in the blink of an eye. All of a sudden, your policies will be very, very efficient, and it happens very, very early in the process. So now that objection surprisingly actually doesn't come up that much, but I think that's out there in the wide world, and it might be someone listening that's like, well, I'd like to do this, but I'm an impatient person. Well, maybe think longer than 10 years. Think longer than 20 years.
Right. I'm reading a book right now called The Slight Edge. It's a pretty old book. By old, I mean maybe 10 or 15 years old. There's been some revisions to it. And somebody gave it to me 10 years ago, and I never even really cracked it open until recently, because I'd finished all the books I was reading and I didn't have a new one, so I just pulled that one off the shelf. But it makes a whole lot of sense, where it's the little things you do every single day that you can't tell the difference today, or maybe even tomorrow, but a year from now, 5 years from now, 10 years from now, those little things you did every single day make a world of difference, because they compound on themselves. So now that delta gets so huge, just like your policy You're doing, hey, I'm going to start where I'm at and do what I can today. And hey, 5 years from now, look back. 10 years from now, look back. 30 years ago was only 1994. Like, that was not that long ago.
Right. I can remember as a kid collecting baseball cards and being like, oh my God, this dude is like Ken Griffey Jr. Like, oh my goodness, he was born in, 1969 or 71, whenever he was born, something like that. And I was like, oh my God, he's such a young baseball player. You fast forward now, the guys are born in the 2000s.
Oh, yeah. When you go to a baseball game, you see, up on the board, it shows their birth dates. And
old enough to be their dad.
Right. You're like, oh, 22. Okay, got it. But then you look at what year that was, like 2002. That was post 9/11. Oh my gosh. That was very recent. So, like, just I say that because time goes that quickly.
Yeah, no question.
And the little things you do today built up over 10, 20, 30 years are going to create incredible differences.
That's right. So, so I want to go back to the original topic, Dave. This just popped into my head, and whether it's financing cars, getting rich with life insurance, buying cars, or getting rich with life insurance, buying real estate, or getting rich with life insurance, doing whatever. What I will say about the buying cars piece, and Nelson demonstrates this in the book. Buying a car generally, and I'm talking about collectibles, just your average, Honda Civic or whatever, right? That is a losing proposition, right?
Right. It's
either way,
it's depreciating liability.
It's a depreciating asset, right? 20% after you drove it right off the lot.
Yeah.
I will say this though: if you're using dividend-paying whole life insurance to finance whatever, whether it's a car, it's a house, down payment on a house, whatever it is,
construction loan,
business, construction loan, right? You're adding efficiency into that process, right? And when it comes to buying cars, you're losing less money,
right? And that's
you're losing less.
You're not going to make up for the fact that you're buying something that's going to decrease in value over time, right? But you have to have a car. You just have to, unless you live in New York City. Or some big metropolis, and
it'll just get stolen if you had one there anyway.
Or you pay more for a parking spot than you would for your car payment every month. But it's just the world we live in. You have to have a car. You have to have some of this stuff just to live and operate and have a job. So you can't prevent losing money from that. But like you said, you can lose less money. You can let less money slip through your fingers as you go through life. And one car purchase may not make that big of a difference, but how many car purchases do you make over a lifetime? I'm not a car guy. I don't switch cars very much, but I've probably had, since I started driving, I don't know, 15, 20 cars.
Oh, wow, that many?
No, maybe not. Maybe a dozen.
That's
12
still
to 15.
a lot.
I'd say probably 12 to 15 cars since I was 18 or 16 years old. Yeah. Well, plus, you got to get two, one for you, one for the wife.
Yeah.
And you change them out every few years or whatever. Like, if you're using that method for all of those car purchases throughout your life, and I probably have more car purchases ahead of me than I have behind me in my life. So that's going to, like, all the money I'm saving with that, it's, I don't want to offend anybody, but I might. That this thing that's going around the internet called girl math. It's hilarious. Have you seen those reels? They're
I've seen a few of them.
Girl math. I returned something to Target and I made $50 today. Like, I tease my wife about that kind of stuff all the time. So I'm not saying this to be offensive, but it's
oh, it's hilarious.
You're not making money by doing this, but you are losing less money.
Right. And I guess a different way to even look at it too is, all things being equal, if you did like if you did the cash method or the finance method, right, and versus the IBC method or the CD method, whatever, but if you used IBC, you are increasing, I suppose, your personal rate of return when it comes to that function in your life, whether it's financing cars, right? You're not making money per se. Again, you're just losing less. But if you can lose, I don't know, 10% less money over a lifetime, just in that one function, what if you added in some of these other functions, right? And again,
Yeah. Right.
meeting your own family's needs, and then maybe meeting my family's needs. Maybe I need to borrow money to go do something, right? I've got a business. I want to go open up a car wash or do something with that. And now you can meet my needs for finance, right? And Nelson talks about that in the book. So recently, just shout out to a couple new clients that were referred to me, but they each read the book twice. These are people in their early 30s, read the book twice, and we had a 2-hour productive, like highly productive conversation about it. So it's amazing when a client puts in the work, and both of them did, which was rare. And she's in dental school. So anyway, shout out to them, just phenomenal. That's what you're after, I think.
Yeah.
But they understood everything and had good questions to ask.
Yeah.
So.
And they're probably going to be like somebody I spoke to today who's at the end of the process. We're reviewing the policy together, ready to put it in force. And we walk through it and he's like, nope, that looks great. I'm excited. Let's do it. Let's get it going. Well, do you have any questions? No, I don't. Like, I understand what I'm doing. I did my research. I understand what I'm looking at here and I'm excited to go. Let's go. That's
amazing.
That's exciting because that's somebody who's is going to stick with it for the long term, and it's only the first of many policies for him and his family.
Yeah, that's right, and that's someone that's less likely to get IBC amnesia, right? And I feel like we're not going to have much or any of that just because you put in the work up front and it's and then people get it. I was talking to our shared client David today. I won't use last names, but David's a good client. Recently came back from Europe, and a guy that's excited to be using a policy loan to go do something that he has to do now that he's back home stateside. And the next step is opening policies for the kiddos, right? And and the wife and stuff like that. So just phenomenal.
Yeah,
but high level of understanding.
Yeah, and high level of understanding doesn't mean you have to have a really detailed understanding. It's just you understand the banking function and that you want to take that over in your own life.
Yeah, it's almost like Nelson made that the title of the book for a reason, because this is more about banking. And it is, right? I'm being silly here, but it's more about banking than anything else.
Yeah.
The function of banking, the financing function in your life, however you want to say it, it's all the same thing.
Yep.
You have a greater need for finance than you do for protection, right? And that's true. But by doing so, by solving your need, using this product, using this process, you will end up with more coverage than you ever would have dreamed of.
Exactly. And therefore making your beneficiaries rich from life insurance, which is the only way to get rich.
It really is.
Yeah.
It really is. Although there's those intangibles, I think, Dave, right? Where it's like people who practice IBC and who, have all those attributes that I think that Nelson envisioned and that we prefer in our clients. And we've had client testimonials, right? They're already more productive just by having implemented the process of becoming their own banker in their life. They're already looking for opportunity, thinking about things more creatively, and maybe being like Dave and being a little bit cheap, like foregoing whatever.
Fiscally responsible, I think is what you
meant.
meant.
That's what I meant. Yeah, that's what I meant.
and fiscally restrained. Yeah, somebody's got to be restrained. Yeah,
that's right.
I don't need to own 7 cars. Not everybody does, but that's all right.
It is a burden.
I have 7 kids, not 7 cars.
Right.
So there you go. We all make choices in life, Paul. Some maybe just chose more wisely than others.
Yeah. All right.
No.
Anything else we want to wrap up?
No, man. I think
you
that's
summed
good.
it up pretty good there.
Yeah.
But you'll all things being equal, if you implement IBC, and I don't care what you're doing, you will be wealthier by practicing IBC using dividend paying whole life than you otherwise would have been not doing it.
Yep. And you'll be wealthier during your lifetime, and your beneficiaries will be much wealthier once you're gone. So there you go. That's
I'm fine with that. I'm fine with your beneficiaries being more wealthy than we were as children. I'm totally fine with that.
And I'm sure they're going to be fine with that too. I know mine will be. So,
Yep.
All right. All right, everybody. Well, hey, have a good week. We will see you back here next week. As always, until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.